Market, Jim, can't really seem to get out of its own way.
I was
lately.
going to ask Jim, for the people at home, how, if you're buying those, how does the other side hedge it other than knock the market down?
Ooh, well, I mean, as we know, the market was down over 200 last night, right, Jim? It came rallying all the way back, Scott, to just before the beginning of the day.
Wasn't that the worst possible for people at home?
Yeah, it was.
It was the worst possible?
And they let them have it with
the officiating
both barrels.
You're always saying that as well.
Right, well, because I don't want people to lose money. I mean, you know, at 4 o'clock, we were down, 4 a.m., we were down at like, I don't know, 15. And then we were down 7. I come back, work out, then it's down 3. I said, oh, my God, it's going to go up. It's going to go up. There's no positive news, and it's going to go up. And then it goes up. I mean, I scanned the papers. Other than for people in Dallas and the Cowboys winning, there was not a single positive piece of information.
I'll give you positive. That's 2 humble brags in a row. One sentence. You're up at 4 a.m. and you worked out. I did neither of those things, believe me.
So,
but you know, I mean, I just don't want people to be picked. None of us wants people to be picked off, and that's what I felt like happened.
Jim, S&P gives up 2,600. NASDAQ correction. Dow goes into correction. Where do you think we go from here? What's driving us mostly now, do you think?
Well, to me, I want to echo what Lee said on fabulous interview last week, which is that what's driving us is just not enough players. I mean, I saw FedEx down $4 on 170,000 shares. I mean, this market, I don't want to call it broken because that sounds scary, but we're having like mini flash crashes every like 15 minutes. And so it's become one of these markets that is just too treacherous. If it's too treacherous, there's not going to be anyone standing there and buying, taking advantage of it. And it's not like the companies can be in there. They're not going to be 2/3 of the volume, not allowed to be. So I just find that the direction, the volatility is negative. We use the term volatility, what we should be saying is selling. Because there's just volatility is making the bids withdraw. Now, I know a lot of people are going to be critical and say, Jim, where were you when it was going up? I said the answer was I didn't like it that way either. Just like I didn't like it up market.
There are plenty of people, Joe, who now think that, I mean, the volatility is not only here to stay, it's going to continue for a long while. Paul Tudor Jones was interviewed this morning by Andrew. Let's listen to what PTJ said, and we can react to it, because it's right about volatility.
I think we're going to see a lot more of what we just saw, which is a lot more volatility. You know, it's really easy to say I'm really bullish, I'm really bearish. I kind of see a two-sided market. I think in the next year will be from where we are today, 10 down and 10 up.
Okay. So your head's going to continue to spin for many months ahead.
Yeah, a lot of different places end up in the same place, a lot of volatility. We've talked about that. That is going to continue. It is going to happen because you have central banks that are stepping back. There's no longer the put underneath the market. But to what Jim and John were just talking about, listen, in the marketplace right now, corporations have stepped back. You don't have the buybacks. They've stepped back because of the Fed. They've stepped back because of trade and tariff. Let's call this market what this is. This is a trading market. People are looking at technicals right now. They're pointing towards the break below the October 29th low. That's probably the reasons why you see further selling. The longer-term investment dollars, I see it. On the asset management side, the entire asset management industry is being priced like active management is basically going to be dead. It's down. The Dow Jones Asset Managers Index is down 30% in the last 6 weeks. You are witnessing significant outflows in mutual funds, outflows in ETFs. Scott, there's no one in there to buy. So, candidly, for me, if I know this is a trading environment, I bought calls in the QQQs, the 161.5 calls. Why?
Down here.
Okay,
down here.
Right here. Right here. Why? Because I get it, guys. We're all trading right now. That's what we're doing right now. There's a tremendous amount of negative sentiment in the marketplace. Okay, you took out the 2,600
tell me
low.
what gets rid.
There's going to be a bounce.
What, Josh, gets rid of the negative sentiment that's in the market? Market seems fixated on the fact that the economy's slowing and slowing faster than people were thinking.
So short term, you need a new high. If you don't get a new high, you're wasting your time. I totally think PTJ is onto something. Down 10, up 10, probably just means what technicians would call an expansion of the range. So now we know 2,600 is not the bottom of the range. We found that out this morning. So you're in a 12.2% drawdown from the late September highs in the S&P. And then you look sector-wise. XLF is straight down. Never seen anything like it. The fundamentals have not changed at these companies. It's pure sentiment. So without a new high in the broad average in the S&P 500, you're not going to get improving sentiment for any particular stock or sector. And RIPs are being sold. It is a different environment. Things have materially changed in terms of sentiment, and maybe that's a precursor to a fundamental change. Right now, I'm not seeing big numbers coming down on earnings.
Nope.
I'm not seeing deterioration in anyone's business or in any
ISM
particular.
is strong.
Right. So it's if you say, well, I'm a fundamentals guy. Okay, that's great, but fundamentals are not going to move as quickly as sentiment does. So right now, this is on psychology. And if you do see an uptick in companies missing expectations, then we'll have a different conversation.
This is the kind of conversation we had, Jim, with Lee Cooperman.
Right.
I want you to let's listen again to what Lee told us, because it's really about psychology versus fundamentals and what you as an investor should perhaps be doing right now.
In my 50 years of doing this, what do I look at? I look at the economy. I look at inflation. I look at monetary policy. I look at valuation. I look at bonds versus stocks. And everything comes up, saying it's a great buying opportunity.
How do you deal with that?
Look, I think Lee's right. I think that every time you buy something, though, you do get hurt. I understand the trading mentality. I look at the XLF, I look at these bank stocks, and it's almost unfathomable that they could go down on very little volume. They go down, they go down, they go down. There's just no bids for them.
20% below the January highs on no change in fundamentals.
Right. I mean, you'd have to believe that one of them is going to go bust, which is ridiculous because they have so much cash.
The big negative is housing, I guess.
Right, and the non-banks, but the non-banks aren't nearly as, there's been notes, non-banks aren't nearly as irresponsible as people think. I don't like them. I think that the Fed should say, listen, we really got to scrutinize non-banks.
Well, lower interest rates, though, Josh, are a fundamental negative for banks.
Lower interest rates.
Falling on margin, some part.
So 2 weeks ago, I was busy panicking about higher rates. So I don't know what should I panic. All right. So here's one thing
exactly what I'm talking about.
I do, and here's one thing that I think is interesting. And we said this the other day. There is no better cure for a fear of high rates than high rates themselves, because all of a sudden you've got the situation now where the 10-year backs off to below 3%. We failed at 305. Right. If that number rings a bell, that was the panic high from the taper tantrum back in the summer of 2013. So 5 years later, we failed at that level once again. So now if you're going to have lower rates on the 10-year, maybe you get people not worrying so much about, oh, no, the Fed's going too far, et cetera. That conversation recedes. And now you say, well, what's the bull case? The bull case probably is a stock-by-stock basis. Have you had enough damage in some of the best-run companies in America that are now selling at 11, 12, 13 times earnings with good dividends, with continued buybacks? So maybe it's not an index conversation for every investor. Maybe it's, hey, what's my favorite name? Oh, my God, I could own that thing 15% lower than where it was 2 months ago, and nothing's changed.
I totally agree with you, but you have to be willing to buy more if it does go down. You have to leave room.
You can't do your entire purchase in one shot.
And I think that's
Fair.
really the best advice we can.
Is this
fair?
Is the market too obsessed with the economy?
I think it's obsessed with the idea that Fed Chairman Powell got it wrong or
went too fast.
Went too fast.
As Barron's suggests, maybe the administration got it wrong in thinking that this corporate tax cut was going to prolong a cycle that was, long in the tooth. That it was going to extend it even further, that it was going to lead to, greater spending, higher earnings, higher stock
a lot of
prices.
that could have happened, Scott, except that then the president chose his battles. He is the president. He chose his battles. He chose to have this trade war. China didn't say, oh, yeah, let's go throw this right in their eye. They didn't do that. We did that.
Well, remember, they've been hitting us. So we're fighting back. I was like, I've been in the Peter Navarro camp for 15 years. No new revelation. We're fighting back. I mean, when I read about what this CFO did from Huawei, I mean, the Canadians don't do our bidding. Okay, the Canadians don't do it.
Fighting back.
They agree
the
with
Barron's article. So the Barron's article goes chapter and verse through every promise that was made surrounding the tax cut, starting with repatriation, which has not hit.
Cash payments to shareholders haven't meaningfully increased. Investment spending hasn't accelerated.
Right. So the question is, do you think that the authors of tax reform actually believed that would happen, or do you think it was a payback to the donor class because they just wanted lower taxes?
I think they believed it. I think they believed it. The fact that it's not happening,
I don't know.
What does that mean for really where the economy is? Is it slowing more dramatically as a result of these things not happening that Barron's lays out?
I've seen higher earnings per share. I've seen a lot of buybacks. Look, I know that they're looking at the data the way that they did, but the companies that I follow have actually used it for the most part.
They're paying down debt, though, too, right?
Paying down debt. That's why I don't. One of the reasons why I want to say you should buy the market, but I'm not, because for everything you said we're going to go down, is because balance sheets are so great. And that's like Lee is talking about balance sheets. Look, we all know that there have been times when interest rates have been 4, 5, or 6, and the balance sheets have been bad. And we'll be sitting here talking about what do you think about
corporate debt has exploded in both nominal terms and relative terms. And a third of the investment grade corporate debt index is a possible candidate for fallen angel status, meaning a downtick in the economy, all of a sudden you'll have some ratings slashed to junk. They're BBB minus right now. So I'm not as sanguine about the balance sheets of corporations. I think they are not as great as people think.
Those are not the systemic risk companies that I would normally be worried.
It's not the financials.
The Bank of America.
I agree with you.
Bank of America is so solid. That to me is America.
Whatever you do, don't look at the industrials.
Okay, fair enough.